Good day, everyone. Thanks for taking your lunchtime, joining me here today as we talk about Secure Act 2.0. My objective, or at least how I started out, was to focus on just IRAs, but we know that when it comes to retirement accounts, our world expands beyond IRAs, right? So I'm going to be touching on some provisions that are not specific to IRAs. And trust me when I tell you that is a good thing. Now, before I get into doing the presentation, I'm going to remind you throughout of some of the benefits that you get as a member of Appleby Consulting, Inc. And I also wanted to alert you to a new product that a lot of you have been asking for. You like my letters, you like my cheat sheets, and you wanted to be able to brand them and share them with your audience. And now you can do that at IRAdigestibles.com. I'm going to be sending out a copy of this PowerPoint deck, so you don't need to write that down. But it's a really easy process. And if you have any questions about that, just feel free to call me. Also, as a member, membership starts at $19.97 per month, depending on the type of membership. Your membership includes sample letters and cheat sheets. Sunday, I was working, Super Bowl Sunday, go Chiefs. And as I'm going through some of my emails, I noticed that an email was kicking back for an attorney. And so I called him expecting to leave a voicemail, and he picked up. And after we chatted a bit, he said, you know, Denise, I want to thank you because I had a question about RMDs. And I remember Natalie Cho saying, Denise knows everything about RMDs. Why don't you go ask her? He goes to my website, registers for the IRA basket, and right there was a cheat sheet where he was able to give the client the answer that the client was looking for. And his comment to me was, the money that I paid for your cheat sheet, whatever I charged the client, more than made up for that, more than 10 times over. So you have that at your fingertips, and I just want to remind you to take advantage of that, because sometimes the answer is right there. Now, if you have a consulting package, you can just email me or call me, depending on what your package allows, and I'll give you the answer. So I just wanted to remind you of that. My son took this photograph, so I'm kind of proud of it. We can't talk about Secure Act 1.0 without talking about Secure Act 2.0, right? Or I should say, we can't talk about Secure Act 2.0 without talking about Secure Act 1.0, because that's where it all started. And we remember that this was signed into law December 20th, became effective January 1st the following year, at least most of the provisions, and it made some significant changes, including limiting the distribution period for designated beneficiaries to 2 years. Then we had the proposed regulations, which made some changes to Secure Act 1.0. I'm mentioning that because sometimes I do get questions about, well, what does the 10-year rule mean, so on and so forth. And as I mentioned before, if you are under one of my consulting packages, you can just email me or call me with that question. You don't need to go look it up. I'm here to save you time, because you have better things to do with your time than to do research. But if you're not under one of my consulting packages, you can just go to my YouTube channel, and that's where I'm adding information on this stuff, so you can listen at your pleasure. Secure Act 2.0, regardless of what anyone says, I love Secure Act 2.0. Most of the stuff in there is great. I'd say maybe 98%. Depends on who you're talking to. Plan administrators are not so happy because of some of the administrative requirements. But overall, from a consumer perspective, everything is great. Almost everything is great. New RMD ages, reduction of excise taxes, a waiver of 10% early distribution penalty, new options for adding to Roth accounts. What's not to love, right? let's talk about the RMD changes first, because that's what got people excited the most. Now, this is an excerpt from my RMD cheat sheet, which you have available if you subscribe. And this answers the question easily. When do I need to start taking RMDs? Once upon a time, we used to say, well, if you reach age 70 and a half before 2020, then you should have started already, right? Because your RMD begun the year you reach age 70 and a half. But now, when someone asks us, what is the required beginning date, or what is the first RMD age? We have to say, well, it depends on what year you were born, because now the year that you were born or the date that you were born drives your applicable RMD age, which is the year for which your RMDs would begin. And you see here, for someone who was born July 30th, 1940, June 30th, 1949 and earlier, they're subject to the 70 and a half rule. Someone who was born between July 1st, 1949 to December 31st, 1950, then they're subject to the 872 rule. But if someone was born between January 1, 1959, January 1, 1951 and December 31st, 1959, for them, it's age 73. Now, what Secure Act 2.0 also says is if someone was born January 1st, 1959 and after, then their RMDs begin at age 75. And right now you're probably thinking, well, there's an overlap here, right? Because we're seeing 1959 falling into both the age 73 and age 75 categories. We think that that is a technical error and expect that to be corrected soon, but it's going to take a while for us to get to those individuals. So we do have some time to allow them to make the change. Now, for someone who reaches their first applicable age, there's still that option to take their RMDs by April 1 of the following year. So that has not changed. Some of you have asked me, how do I communicate this to clients? Well, if you're not a member, you can go to IRAdigestibles.com, and there's a sample letter and a sample RMD cheat sheets that you can use to share that information with clients. Here's something that we need to bear in mind. Secure Act 2.0 was signed into law on December 29, 2022. Last minute, right? I don't know why they keep doing this to us, but it was signed on December 29, and some of the provisions, including the RMD changes, became effective like 2 days later. What does that mean? Even though it's beneficial to taxpayers, it's hard for custodians because a lot of the custodians already had their RMD notices teed out to be sent out to IRA owners. Now recall that IRA owners must receive an RMD notice by January 31st of the year for which an RMD is due. So why is this an issue? Those who reach age 72 in 2023 does not have an RMD for 2023. But they would have gotten that notice from most custodians. I've seen them. And now these taxpayers are confused. What should I do with this notice that's telling me that I'm supposed to take an RMD, and now my advisor is telling me something different? What I'm telling people, chuck it in the garbage. They don't need it. It does not apply anymore. It's due to limitations why the custodian was unable to stop that notice. Now you're going to have some clients who took those RMDs because they got that letter. They are not technically RMD amounts if they reach age 72 in 2023. Those distributions are not RMDs. What does that mean? It means that they can be rolled over. So if you have a client who said, I took this RMD, now I find out that it's really not an RMD and I didn't have to take it, what can I do? Well, you can roll it over within 60 days, but before you tell a client to roll it over within 60 days, we got to find out, will this rollover break the 1 per year rollover rule? Because if it's going to break the rule, then it cannot be rolled over. But there are solutions. If the client is a participant in, say, a 403b or 401k, and that plan accepts rollovers, then they can roll over that amount to the plan. That would make it a non-taxable rollover. But what if they're not a participant in any one of those plans? Then picture this with me. If they don't roll it over, it's going to be included in income, right? Why not put it in a Roth IRA? It's going to be included in income anyway. But the good thing is that earnings are going to go tax deferred and will be tax free once they're eligible for a qualified distribution. There's also the 60-day deadline to think about, because some of these individuals will not be aware that there's an issue until well after the 60-day deadline. What should they do then? Well, if they come to see you, remember that I think it's the most recent notice is 2009-42 or 2020-46. Notice 2020-46, where the IRS updated the list of reasons that an individual can use to get a waiver of the 60-day deadline. And this would definitely be one of those where IRA owners were told by custodians that they needed to take a distribution when they didn't. So if they find out after the 60-day deadline, they can use the self-certification option to complete this rollover after the 60-day deadline, and that would make it an effective rollover. If you have one of these issues that come up and you're not sure what to do, please let me know. No RMDs for designated Roth accounts, another good change. This is effective for 2024. Now, we know that for Roth IRAs, there's no RMDs for owners, right? Only for beneficiaries. And so for a lot of us, we felt like that was unfair to designated Roth accounts. And some advisors use the strategy of trying to get amounts from the designated Roth account to the Roth IRA before the individual was subject to the RMD rules. Now, we don't need to do that anymore come 2024. RMDs will still apply to beneficiaries of designated Roth accounts, but they won't apply to the owner. And just as a reminder, a designated Roth account is a Roth 401k, Roth 403b, or governmental Roth 457b accounts. So those are not subject to RMD rules anymore. And that means that when you're having the conversation with someone who owns one of these accounts and they want to roll it over to a Roth IRA, you don't have to worry about, is there any amount that has to be distributed to them first because it represents an RMD? Don't have to worry about that anymore come 2024. Spouse beneficiary may treat employer plan as own. Don't be fooled by this terminology, because when I read the headlines first, and this is the headline as written in Secure Act 2.0, I thought, what? That sounds odd, but it's not really a treat as own provision, because they can't make contributions to the account. They can't take loans. You know, the benefits that are available to a real owner of the account are not available. So what's really changed? Now, you remember that for IRAs, a spouse beneficiary can move that IRA to their own account. And in that case, they would be able to take distributions using the uniform lifetime table. What's the benefit here? Before Secure Act 2.0, if the assets remained in an employer plan, they would have to take distributions using their single life expectancy, which produces a higher RMD amount than the uniform lifetime table. Because remember, the uniform lifetime table is based on the assumption that the individual has a beneficiary who's 10 years younger than they are. So now the spouse beneficiaries do have that option to make an irrevocable election to treat the inherited 401k or 403b as their own for purposes of calculating how much distributions they must take as a beneficiary. Now, of course, one of the questions that comes up is, how is this election going to be made? Because as you're sitting with the client in your office and they're telling you that they are a spouse beneficiary, and you're thinking, oh, so you want to keep those assets in a 401k? Let's talk about how you can elect to use the uniform lifetime table as opposed to taking distributions over your single life expectancy. Well, the procedure has not been written yet. The IRS is supposed to provide guidance on that. My opinion is that they're just going to copy and paste what already exists for beneficiaries to make an election as to which distribution options they want to choose if the account owner died before the required beginning date. And all they would have to do is to make the necessary modification to that to make it available to spouse beneficiaries to choose the uniform lifetime table. But it's good news. They still have time. We're just in the beginning of 2023. So plan administrators do have time to implement this provision and make it available to spouse beneficiaries. Another plus. Now, for those of you who have called me about RMDs for annuitized IRAs or have done the research on your own, you know that we cannot aggregate RMDs with annuitized annuities and regular IRAs, right? And the problem with that is sometimes the annuity payments are so much so that they really could cover the RMDs from the non-annuitized IRAs. Well, recognizing that that really is an issue, Secure Act 2.0 now says effective from the date of amendment, RMDs can be aggregated for annuities and non-annuity IRAs. We're still expecting some guidance to be made available for that, but the provision on the Secure Act 2.0 says that taxpayers may rely upon their reasonably good faith interpretation of the provision until we have, let's call it plain English explanations from the IRS. So if you do have a client who has questions about that, please feel free to call me. Someone is asking, for designated Roth account, does it include TSVs too? Yes, absolutely. All classes of designated Roth accounts. Good question. Please keep the questions coming. Here is another great change, a reduction of the 50% excess accumulation penalty, which we would all agree was just too much, man. For not taking your RMDs, you're going to owe the IRS a 50% excise tax. Now, we know that the IRS will waive the penalty or excise tax if the deadline was missed due to reasonable cause. And in my experience, they have never denied a waiver request unless the form 5329 was filled out incorrectly. So, 100% success rate. But still, there could be an instance where the IRS denied the waiver request, but now the penalty is only 25%, and that is reduced to 10% if it's corrected timely. What does timely mean? I have an article on my website, and in that same database where I have resources for financial advisors, where I explain what timely means for purposes of making the correction, which means taking the RMD. If it's taken by a particular deadline, then it's reduced to 10%. But one of the questions that comes up is, well, maybe I don't want to pay the 10% either, because that's a lot, right? The section of the tax code that addresses requesting a waiver of the excise tax was not repealed by Secure Act 2.0, which means that your client, if they miss the deadline due to a reasonable error, can still have their tax professional request a waiver of the 10%. Early distribution penalty exception. The good stuff just keeps coming from Secure Act 2.0. 72T payments. One of the challenges with starting a 72T payment on an account is that you got to keep those assets segregated into one account for the duration of the 72T program. Let's say you start a 72T program, an IRA number 1. You're locked into that account. Yes, you could move the entire account to a brand new account that has no other assets, but you couldn't do a partial transfer. You couldn't do a partial rollover. Recognizing that that was unreasonable, Secure Act 2.0 now allows an individual to split that account as long as they continue taking the required 72T payments amount. Now, you got to be careful here, because what you don't want to do is commingle the 72T assets with any assets that was not involved in the correction. So you have a client who does a 72T payment on IRA number 1. They can split that into IRA number 1 and IRA number 2, but they can't bring in any assets from outside that was not involved in the 72T calculation from the get-go. So this allows some flexibility if you have a client who's taking a 72T program, say from a 401k account, and they want to roll over part of that to an IRA. It used to be an all or nothing solution, but now they can split it. Of course, there's the issue of whether the plan would allow a partial rollover, but from a regulatory perspective, it is permitted. How do you communicate the 72T payment rules to a client? Well, if you go to IRA digestibles, I have a sample letter that you can use. Exception for terminal illness. If someone is terminally ill and a physician has certified that that condition is expected to result in death within 84 months or less after the certification date, then distributions taken by that individual is exempted from the 10% early distribution penalty. Now, I know at least one of you are thinking, well, what if that person lived past 84 months? Are we going to have to go back and pay the penalty? No, because it says reasonably expected to result in death. And we know that sometimes there are medical miracles or unexplained things that where a physician has determined that someone would live for X time and they live for years after that. But that doesn't matter. If they live past that, then that's great. But it does not disqualify them from eligibility if they were originally certified as having an illness or physical condition, which could reasonably be expected to result in death within 84 months. And that's immediately effective. So if you have a client who's terminally ill and they want to take distributions from their retirement account and they're concerned about the 10% early distribution penalty, well, here's a solution. Return of excess contributions. Remember when someone made an excess contribution to their IRA and they correct it by tax filing due date plus extension in order to avoid the 6% excise tax? In that case, they had to include the earnings as part of the correction, right? But the challenge was the earnings, or the NIA, let me back up a second. The net income attributable to the return of excess can be earnings or loss. But if it's earnings, it has to be included in income and subject to the 10% early distribution penalty if the correction occurs before age 59 and a half, right? Now, Secure Act 2.0 is saying, well, we appreciate that you're making this correction. Sure, it shouldn't be in the account in the first place. So you are going to pay income taxes on the earnings, but we're not going to ding you by including a 10% early distribution penalty. So another good thing, this is great, your clients won't owe that 10% early distribution penalty. And this one is capped at the lesser of $10,000 or 50% of their vested account balance if the distribution is taken during the 1-year period that begins on the date of domestic abuse. And this abuse can be by a spouse or a domestic partner. So it's not much, but it's still something, right? You take this distribution, it's exempted from the 10% early distribution penalty. And I don't know why that they have put off this from being effective for up to a year, because abuse doesn't wait around, but at least we know that there is this provision that's available. And if the abuse occurs in the middle of 2023, then remember that the distribution can be taken during the 1-year period that begins on the date of the domestic abuse. So they could still take it in 2024 and be exempted from the 10% early distribution penalty. Protection of IRAs, prohibited transaction aggregation. They're not telling us anything new here, because this is something that we have been doing, right? We do have clients who get adventurous and want to invest in non-traditional investments. They want to buy real estate, they want to invest in machinery or whatever that's not available on the as a publicly traded asset. And so while that can be helpful to some individuals because it could make them a lot of money, in other cases, if it's not done right, if they don't involve an ERISA attorney to make sure that the investment does not result in a prohibited transaction, they could lose their IRA. If the transaction is determined to be a prohibited transaction, then the IRA is treated as if it was distributed by January 1st of the year in which the prohibited transaction occurred. There are exceptions, of course. And so what we used to tell individuals is, if you're going to do that, then you want to keep those assets in an IRA over here and don't mix that up with your other IRAs that are over there, so that if anything goes bad, then only that IRA is disqualified. So they're just confirming what we have always been saying, but it's still good to know that they agree that what we have been saying all along is right. So just a little reminder for your clients who want to invest in non-traditional assets that could result in a prohibited transaction. Statute of limitation for the 6% and the 25% excise tax. The 25% excise tax is what applies when the R&D deadline is missed, right? The 6% excise tax is what applies when a return of excess from an IRA is not done by tax filing due date plus extension. The 6% excise tax accrues for every year. The excess remains in the IRA. And I included a case here. This person owes the IRS about $8.5 million because they had an ineligible rollover that was made to their IRA and they didn't correct it by the deadline. Now, if you don't correct an ineligible rollover that was made to an IRA, it accrues a 6% excise tax for every year it remains in the IRA. And in this case, it amounted to $8.5 million. Now, here's the issue. If this individual had filed IRS Form 5329, it would have started the statutes of limitations for this excise tax, and they wouldn't have owed so much. But, in Secure Act 2.0, they acknowledge that not a lot of people are aware of Form 5329. Everybody knows you're supposed to file your 1040, right? But who knows about Form 5329? Not everyone, not many people. And so what they've done now is change the rules to say the statute of limitation starts when you file your tax return. You don't have to file Form 5329 for the statute of limitation to start. And that's going to result in a lot of savings for people who make excess contributions to their IRA and didn't realize it, so they didn't correct that excess contribution by the deadline. Now, we got to be careful here because these have to be legitimate excess contributions. It does not apply to bargain sales. Now, remember a few years ago, there were individuals who were investing assets in their IRAs, non-publicly traded assets, and they were valuing those at a market value that was much lower than what the true market value is, right? And so by the time they were ready to take distributions from their IRA, the market value would have gone up and they would have had this significant amount of tax-free earnings. Well, the IRS caught wind of that and they call them abusive Roth IRA transactions. Those abusive Roth IRA transactions would result in excess contributions, and they don't qualify for this provision where the statute of limitations starts when the tax return is filed. Roth provisions, we have a lot of these, and the first one I want to talk about is 529 to Roth. So I'll give you a little bit of background. As we know, contributions can be made to 529 plans for beneficiaries, like the kid in this case who would be going to college or would be the beneficiary. The beneficiary in this case is not used in the same context as we would for who's a beneficiary of an IRA. But sometimes a beneficiary might not go to college, or they might get scholarships. And so at the end of their education, they still have this bucket of money in their 529 plan. And if there's not a family member that they can give it to, an eligible family member, then the only option is to take a distribution of that amount. And what happens then? The earnings will be subject to income tax and the 10% early distribution penalty unless they qualify for an exception. And so this is a solution here where such a beneficiary is allowed to move up to $35,000 from their 529 plan to a Roth IRA. Now, we got to be careful here because there are certain limitations that apply. For instance, the 529 plan must have been maintained for at least 15 years at the time the amount is moved from the 529 plan to the Roth IRA. The movement has to be done as a direct trustee-to-trustee transfer. So if they take it out, put it in their checking account, then they cannot subsequently put it in the Roth IRA. It has to go directly from trustee to trustee. And the amount has to have been in the 529 plan for at least 5 years. So for individuals who are thinking, great, this is an opportunity for me to just stuff it into the 529 plan within the last 5 years and then roll it over, can't do that, because any amount that has not been in the 529 plan for at least 5 years is not eligible to be moved to the Roth IRA. And you can't move the entire amount all at once because the amount that you move is subject to the IRA contribution limit. So what we're going to have to do now for a client who wants to do this is ask the question, have you made a contribution to your traditional or Roth IRA? Because if you have, we have to add that to the amount that you want to move from your 529 to your Roth IRA, and the total cannot exceed your IRA contribution limit for the year. Now, once the assets move to the Roth IRA, they become subject to the Roth IRA distribution rules, the requirements for qualified distributions, the ordering rules, 10% early distribution penalty on certain non-qualified distributions, etc. And this provision is effective for 2024. Now, one person is asking, can we switch the beneficiary from one child to parent and then from parents to Roth? I don't think it's impossible if the parent meets the requirement, but I don't know. That has not been addressed in Secure Act 2.0. But usually what happens, as we know, is that proposed regulations will be issued and all these questions should be flushed out in the proposed regulations. But that's a smart strategy. Right now, there's nothing that says no, but we just got to be careful. It's definitely something that we can think about, but I wouldn't recommend it to a client because we don't have anything to hang our hat on as far as that's concerned. Now, I talked about no RMDs for designated Roth accounts earlier under the RMD section, but I included it here because I wanted to highlight one of the provisions. This is effective for taxable years after 2023, right? But it does not apply to RMDs for 2023, even if they're deferred until 2024. Because remember, your 2023 RMD, if it's your first RMD, can be taken in 2024. Is that a 2024 distribution for tax purposes? Yes. Is that a 2024 distribution for purposes of not being an RMD? No. So we have to make that distinction when we're having the conversations with the beneficiaries. Another great Roth provision, SEP and simple Roth IRAs. That's effective now. Are custodians equipped to deal with it? Probably not, hopefully by the end of the year. But as of now, if an employee elects, and if it's available on the custodian's platform and the employer offers it, they can make Roth contributions to SEPs and simples. That's pretty new, right? Because one of the questions that I usually get is, can I make a Roth contribution to my SEP or simple IRA. Up until now, the answer is no. Now, those contributions are going to be made on an after-tax basis, which means they're going to be included in the income of the employee. Now, there are certain rules that still apply. The Roth distribution rules, is a distribution qualified? If not, does the ordering rule apply? Absolutely. Those still apply to those Roth contributions. And for simple IRAs, the 2-year rule applies, which means that you can't move money from a simple or to a simple unless the movement is being done to or from another simple, unless the simple has been funded for at least 2 years. So you want to move a traditional IRA into a simple, you got to ask, has it been at least 2 years since the first simple contribution was made? If the answer is no, can't do it. If the answer is yes, then you can. Catch up for Roth contributions. Another Roth provision. Catch up contributions can be made on a pre-tax or on a Roth basis if the plan has a designated Roth account feature. Now, under Secure Act 2.0, all catch-up contributions are subject to Roth treatment, except for employees with compensation of $145,000 or less. And it does not apply to SEP and simple IRAs. So this is one of those good provisions that did not carry over to SEP and simple IRAs. And this applies to 2024. Roth matching contributions. Now, we remember that right now, if someone, when I say right now, I mean before Secure Act 2.0, if someone participates in a 401k plan, for instance, that has a Roth feature and they make salary deferral contributions, any matching or non-elective contribution made by the employer had to go to the traditional side, right? They agree that this really didn't make sense because I'm choosing to put money in my Roth account. Why shouldn't my matching contributions be made to my Roth account as well? And now Secure Act 2.0 allows employers to give employees the option of receiving matching contributions in their Roth accounts. Now, something that employees have to think about as they choose whether or not to have those contributions made to their Roth account is how it's going to affect me from an income tax perspective. Because instead of the income being deferred until they take distributions, as it would have been if the contributions were made to the traditional side of their accounts, it's going to be included in income for the year of the contribution. Now, what I don't know and what is not clear is what year is that? Because remember, an employer contribution can be made by tax filing due date plus extension. Now, if the contribution is made in the year to which it applies, we know it's going to be included in income for that year. But what the Secure Act 2.0 did not address is, what if the contribution is made the following year for the previous year? Which year is going to be included in income then? Because you as an advisor, when you advise your client as to whether or not they should choose the Roth feature, that's part of what you're going to think about, right? Especially when you work with their tax advisor. How is it going to affect the client from an income tax perspective? Because they can change from year to year. This year, they could choose to receive it on the traditional side. Next year, they could choose to receive it on the Roth side, but that's definitely a tax planning question. And before we advise clients, we need to know which year is the amount going to be included in income if the employer makes the contribution the following year instead of the year to which the contribution applies. Now, there are some provisions that encourage savings. We're familiar with the Savers Credit, where an individual would receive a non-refundable tax credit if their income fell on the certain amounts. Now, this is being changed to a savers match. And I think this is easier to explain to taxpayers. What is a non-refundable tax credit? The ordinary people who are not in the tax arena don't know what that means. But now we can tell them, listen, if you put money in your IRA or you make salary deferral contributions to your 401k, the IRS is going to give you back some of that money. And it will go directly to your IRA or employer plan account. And that's considered free money And one of the arguments that can be used to help lower income individuals, or to help convince them that adding money to their retirement account is a good thing, because we know for most of these individuals, the concern right now is surviving, putting food on the table. They're not thinking about retirement. That's in the future, right? But we know still that they should save. And this is one of the arguments that can be used to help convince them to add money to their IRAs and employer plan accounts. That, coupled with taking a deduction for an IRA contribution, or making contributions on a pre-tax basis. And I know for many of you, this is not your usual clientele, but you could be working with a wealthy client who has a kid or a friend or family, someone who works for them, who falls into this category, and this would be helpful to them. I have a client who uses the Savers Match to help convince members of his church to add to their retirement savings account. And that's his way of giving back to the community. And it has been very successful. IRA catch-up contributions, finally, it's now indexed for inflation, which means when we see regular IRA contributions going up due to inflation, then we'll see catch-up contributions being indexed for inflation as well. Student loan repayments. Those who make qualified student loan repayments, the employers are allowed to make matching contributions to their 401ks, 403bs, or governmental 457b plans, or even simple IRAs. So now another benefit of repaying your student loan, your employer could give you a matching contribution for those student loan repayments. Higher catch-up contribution limits. Right now, if we make a catch-up contribution limit to a simple IRA, simple 401k, or 401k 403b, you got to be at least age 50 by the end of the year in order to do that. And the catch-up contribution limit is $3,500 for simples and $7,500 for 401k 403b type plans. Now, Secure Act 2.0, effective for 2025, has changed that. For individuals 60, 61, 62, and 63, as of the end of the year, their catch-up contribution is $5,000, the greater of $5,000, or 150% of the dollar limit in effect for 2025. And I put that in red and the question sign because I think it might be 2024 they intended to say, but we'll see. There are several other areas where there are obvious mistakes, and we expect that to be corrected in technical corrections. And this might be one of those, because I don't understand why it would be 2025 here. For 401ks, it's the greater of $10,000 or 150% of the dollar limit in effect for 2024. 401ks, 403bs, governmental 457b plans. Additional simple IRA non-elective contributions. We know right now, simple contributions from the employer is either 2% non-elective or dollar for dollar up to 3% for matching contributions. Now, Secure Act 2.0 allows additional non-elective contributions of the lesser of $10,000, 10% or $5,000. Exclude my tongue time. This is my fourth webinar since this morning. The employee must be an eligible participant and has at least $5,000 in compensation. And these are subject to the compensation cap. Now, I'm going to be doing a webinar on simple IRAs in about the next month to 6 weeks. And I'll explain how the compensation cap works in terms of simple IRAs, because it does not always apply. So my presentation is going to include this update, even though it's effective for plan years beginning after 2023. Still good to know. So what are some of the things that we can do to help clients, right? There is so much, and really it's, in my opinion, no different from the other steps that we would have taken for other changes. Look for opportunities for tax efficient distribution strategies. Look for opportunities where individuals can add more to their retirement savings accounts. Is your client eligible for a waiver of the 10% early distribution penalty? You would be surprised how many cases I come across where individuals are eligible for an exception to the 10% early distribution penalty, but the tax preparer doesn't know. And so they pay that anyway. And in many cases, this applies because the IRA custodian is not required to report all exceptions when they issue a Form 1099-R. In some of the cases, for instance, if you take a distribution for a first-time home buyer, maybe for domestic abuse, as covered here, then the IRA custodian uses a code 1 if the individual is under age 59 and a half, because the IRS tells them, you don't know what these funds are being used for. You're not supposed to use an exception code. And in that case, the tax preparer files Form 5329 to override the code 1 that the IRA custodian uses. So you want to look out for that. And if you are not the person who does your client's tax return, just remind them to remind their tax preparer of the reason for the distribution so that the tax preparer knows to claim the exception to the 10% early distribution penalty. And now a lot of this has to do with communication, right? Like yesterday, I got an email from one of my clients saying, we need something that we can share with clients that explains the 10-year rule clearly. And of course, this is where you come for that. So I am working on a client-facing letter that I'm going to send out. I did send out one earlier, but to be honest, I have not updated it since Notice 2022-53 was published in, I think, October. I did send out a letter that talks about Notice 2022-53, but I need to update the one that includes all beneficiaries in the one client-facing letter so that when you share that with your client, you can say, listen, this is the category that you fall into as a beneficiary, and these are the factors that you look at to determine if you fall into this category. And depending on the category that you fall into, these are your distribution options. So I'm going to be sending that out soon. And of course, as usual, I'll send you an email so you know that it's there and you'll know where to get it. Now, if you're on here and you need to follow me on social media, because I do a lot of updates on social media, and it's every time I post anything, except for my personal Facebook page, it's always about IRAs. So if you want to know what's going on, then follow me on LinkedIn. YouTube is where I'm uploading some of these webinars right now. I'm also on Instagram. My son said I should say IG because that makes me sound cooler. So I'm on IG too, and I'm on Twitter. So I look forward to you following me. But what I look forward to most of all is you sending me your IRA questions and you sending me your ideas, like the one I got yesterday saying we need an updated letter on the 10-year rule. Let's break it down like only you can, Denise, so that the consumer understands it. Is there other types of letters that you want to be able to share with your clients? Just send me your ideas. That's what I'm here for. I'm here to make sure that your job is easier when you're communicating to clients. I'm here to make sure that you have the information that you need to help your clients avoid making mistakes. Like that person I talked about earlier, he was able to just pull up my RMD cheat sheet and was able to say to the client, oh, you don't have to worry about taking RMDs now because the rules have changed and you're reaching age 72 after 2022. So no RMDs for you, right? Questions like that, I want you to have the answer to at your fingertips. And if you are under one of my consulting packages, then be able to call me or email me as often as you want to. Thank you for your time. Please let me know if you have any questions. Okay, here's one. Talk again about the disability exception. Are you talking about the terminally ill provision? That might be it. Yeah, so if your client tells you that they're terminally ill and they want to take money out of their retirement account it doesn't have to be for any particular reason. It just says if you have been certified by a physician to have a condition that could result in death within 84 months of the date of certification, then your distributions are automatically exempted from the 10% early distribution penalty. So it's due to your condition, but it doesn't have to be for the purposes of covering your medical expenses or anything like that, just like the disability distribution. Now, with the disability distribution, some custodians ask for documented proof, some don't. We'll see whether or not this is one of those that they're required to report as an exception. And if it is, then they might ask for additional paperwork. But the IRS will give us guidance on that. Is the excise tax really 8.5 million for that person? Yes, it's 8.5 million, and he actually took the IRS to court, and the court agreed with the IRS that he owed the excise tax, $8.5 million. Now, I know what some of you do, especially for your high net worth clients, is you conduct an IRA audit every year. Right. And if he had been working with an advisor who conducted an IRA audit, then he might have caught this. Not in all cases, right? Because as an advisor, if the plan administrator is rolling over an amount to an IRA, you're going to assume that it is an eligible rollover, because there's some ineligible rollovers that is hard to detect. Asking someone, did you take your RMD before you did a rollover? That's an easy one, right? But in this case, where it was a type of investment that was not permitted and shouldn't have been rolled over, you probably would not have known. So, but you would have known to say to him, you need to file Form 5329 to start the statutes of limitation. And that's one of the benefits of using IRA advisors like you, who knows IRA rules. Or even if you don't know it off the top of your head, you know enough to say, listen, there's something else I need to do. Let me go check. Let me email Denise or call Denise or check some of my resources, right? Because as we agree all the time, there's nothing that says you have to know the information off the top of your head, but the light bulb should go off to say, I need to check further before I give the client this response. Any more questions? The Roth for SEP and Simples. Well, this question is, how will the Roth for SEP and Simples work? The employer will have to notify the employees to set up a Roth IRA. So say, for instance, it's a simple. Right now, how it works is, depending on the simple IRA agreement, the employer tells the employee, you got to set up a simple IRA. This is the paperwork that you use. Let me know what your account number is, and I'll send the contributions to the account. Some simple IRA agreements require the employees to keep their accounts at a particular financial institution. That's the 5305 simple. The 5304 simple allows the employee to choose to keep their IRA wherever they want to. So, apart from that, the requirement is that they have to notify employees if they're offering it. Employees have to set up their Roth IRA under whether it's a SEP or simple, and inform the employer of where the account is, what's the account number, so the employer can send the contributions there. And of course, before that, they have to make the election to treat the contribution as Roth, because that gives the employer the acknowledgement that they know it's going to be reported as an amount that's included in income. I don't see any more questions. If you think of any question that you'd like me to answer, please send me an email. Those of you who are members, you have my other email address. And And for those of you who are not yet members, please send questions to training@deniseappleby.com. What I plan to do is compile the questions that I receive and send out a document to everyone, because I guarantee if you're thinking of a question, someone else is and would be happy that you put that on the list. Thank you for your time. Enjoy the rest of your day.